preference shares are those which enjoy the following two preferential rights. Number 1, dividend at a fixed rate or a fixed amount on these shares before any dividend on equity shares is given. Number 2, return of preference share capital before the return of equity share capital at the time of winding up of the company. Preference shares also have a right to participate or in part in excess profits left after being paid to equity shares, or has a right to participate in the premium at the time of redemption. But these shares do not carry voting rights. Types of preference shares. Following are the major types of preference shares. Number 1, cumulative preference shares. When unpaid dividends on preference shares are treated as arrears and are carried forward to subsequent years, then such preference shares are known as cumulative preference shares. It means unpaid dividend on such shares is accumulated till it is paid off in full. 2. Non-cumulative preference shares. Non-cumulative preference shares are those type of preference shares which have a right to get fixed rate of dividend out of the profits of current years only. They do not carry the right to receive arrears of dividend. If a company fails to pay dividend in a particular year, then that need not be paid out of future profits. 3. Redeemable preference shares. Redeemable preference shares are those preference shares which can be redeemed or repaid after the expiry of a fixed period or after giving the prescribed notice as desired by the company. These are known as redeemable preference shares. Terms of redemption are announced at the time of issue of such shares. 4. Non-redeemable preference shares. These preference shares which cannot be redeemed during the lifetime of the company are known as non-redeemable preference shares. The amount of such shares is paid at the time of liquidation of the company. 5. Participating preference shares. These preference shares which have a right to participate in any surplus profit of the company after paying the equity shareholders in addition to the fixed rate of their dividend are called as participating preference shares. 6. Non-participating preference shares. Preference shares which have no right to participate on the surplus profit or in any surplus on liquidation of the company are called as non-participating preference shares. 7. Convertible preference shares. These preference shares which can be converted into equity shares at the option of the holders after a fixed period according to the terms and conditions of their issue are known as convertible preference shares. 8. Non-convertible preference shares. These preference shares which are not convertible into equity shares are called as non-convertible preference shares. Preference shares, also referred to as preferred securities, preferred stock or preference shares, are classified as hybrid instruments because they combine both equity-like and debt-like characteristics. There are a number of instruments that can be considered hybrid. due to this spectrum and in particular for credit considerations, Moody's coined the phrase debt equity continuum to better quantify the degree of equity or debt-like behavior of a given hybrid instrument. The general characteristics that are used to classify hybrid instruments are: number 1, type of interest paid, that is dividend or coupon, fixed or floating, participating or non-participating, deferable or non-deferable. 2, the maturity of the instrument, that is fixed or perpetual. Number 3, features of redemption such as callable, puttable, extendable, and 4, other forms of optionality such as convertibility to ordinary equity. Preference shares are hybrid instruments that: number 5, pay fixed or prime linked dividends rather than ordinary dividends or coupons. 6, typically have deferable dividends. 7, these have dividends that must be paid before ordinary dividends. 8, these can be perpetual, that is non-redeemable or of very long maturity period. 9, they may be cumulative or non-cumulative, such as for cumulative preference shares, deferred dividends must be paid in arrears. 10, these may be participating or non-participating, that is, for non-participating preference shares, holders have no or limited rights to a company's profit and capital above the stated dividend and initial capital invested, even in the event of a wind-up. 11, generally confer limited voting rights, that is, only in the event that a dividend is in arrears. And 12, they may have convertible, callable, puttable, or other optionality features. The exact features of a preference share issue are detailed in terms of issue. There are several benefits of a preference share form from the point of view of a company which are being discussed. Number 1, no legal obligation for dividend payment. There is no compulsion of payment of preference dividend because non-payment of dividend does not amount to bankruptcy. This dividend is not a fixed liability like the interest on debt which has to be paid in all circumstances. 2, it improves borrowing capacity. Preference shares become a part of net worth and therefore reduces debt to equity ratio. This is how the overall borrowing capacity of the company increases. Number 3, no dilution in control. Issue of preference share does not lead to dilution in control of existing equity shareholders because the voting rights are not attached to issue of preference share capital. The preference shareholders invest their capital with fixed dividend percentage, but they do not get control rights with them. 4, no charges on assets. While taking a term loan security needs to be given to the financial institutions in the form of primary security and collateral security. There are no such requirements and therefore the company gets the required money and the assets also remain free of any kind of charges on them. The main limitation of preference shares is that they do not carry the voting rights and therefore cannot participate in company's decision-making process. However, under certain special circumstances, they can get the rights in proportion which the paid up share capital on their shares bear to the total equity share capital of the company. Preference shares are considered a very costly source of finance, which is apparently seen when they are compared with debt as a source of finance. The interest on debt is a tax deductible expense, whereas the dividend of preference shares is paid out of divisible profits of the company, that is, profit after taxes and all other expenses. For example, the dividend on preference shares is 9% and interest on debt is 10% with prevailing tax rate assumed to be 50%, the effective cost of preference is same, that is 9%, but that of the debt is 5%, that is 10% multiplied by bracket start 1 minus 50% bracket closes. The tax shield is the main element which makes all the difference. In no tax regime, the preference shares would be comparable to the debt, but such scenario is just an imagination. Skipping of dividend payment may not harm the company legally, but it would always create a dent on the image of the company. While applying for some kind of debt or any other kind of finance, the lender would have this as a major concern. Under such a situation, counting skipping of dividend as an advantage is just a fancy. Particularly, a company cannot afford to take such a risk.
Indian Companies Act categorizes the share capital of a company into two categories, namely equity share capital and preference share capital. We shall discuss the preference share capital in this module. Preference shares are that part of the company's share capital which carry a preferential rights as to receive dividend at a fixed rate or amount, and repayment of capital in case of winding up of the company. Preference shares are hybrid securities of debt and equity because the company is obliged to pay a fixed rate of dividend to preference shareholders before anything can be distributed to the equity shareholders, but this payment is not tax deductible. They carry a prior right to receive dividends over the equity shareholders. Also, preference dividend, if unpaid, gets accumulated over the years in case of cumulative preference shares. Preference shares may be redeemable or irredeemable, but now irredeemable preference shares are not allowed. They have to be redeemed in maximum 10 years. The main limitation of preference shares is that they do not carry the voting rights, and therefore the preference shareholders cannot participate in the company's decision making. However, as per the Indian company law, in case of non-payment of dividend for non-cumulative preference shares for a period of not less than 2 years ending with expiry of the financial year immediately preceding the commencement of the meeting, or in respect of an aggregate period of not less than 3 years comprised in the 6 years ending with expiry of the financial year aforesaid, such preference shares shall attain voting rights. Thus, in case issuing company fail to pay dividend, such preference shares shall carry voting rights, but shall be non-convertible. Further, the cumulative preference shares can vote if their dividend is in arrears for 2 years. The voting right of each preference shareholder is to be in the proportion which the paid up share capital on his shares bears to the total equity share capital of the company. Before 2013, there were no regulations to govern the issue and listing of non-convertible redeemable preference shares. So, in order to fill this gap, Securities and Exchange Board of India issued regulations for in 2013. The essence of regulations is to provide for mandatory listing of preference shares which are offered to public, permit listing of preference shares which are though privately offered but may be listed. There are two types of preference shares: irredeemable preference shares and redeemable preference shares. In case of irredeemable preference shares, time to maturity is not specified, whereas in case of redeemable preference shares, the maturity period is specified. Let us now proceed to understand how to calculate the cost of irredeemable preference share capital. It is the annual preference share dividend divided by the net proceeds from the sale of preference shares. The formula for the same is shown here, where Kp is the cost of preference share capital, Pd is the annual dividend payment, P0 is the issue price or net proceeds collected from the sale of a security. Before solving practical problems, it is important to take into account the adjustments for flotation cost and the discount, if any. Flotation costs are the total cost of issuing and selling a security. They include two components: underwriting cost, which is the compensation earned by investment bankers for selling the security; administrative cost, consisting of issuer expenses such as legal, accounting, and printing. Such dividend paid on preference share capital is not a tax-deductible expense. The cost of preference share capital is not adjusted for taxes. Dividend is paid to preference shareholders from after-tax profits. It should be noted that the required rate of return on preferred stock is the yield demanded by investors, and it differs from the company's cost of preferred equity because of the cost of issuing additional shares, that is the flotation cost. For instance, a limited issue 13% preference share capital with face value of rupees 100 at a discount of 4%. Flotation cost is 2%. For calculating the cost of preference share capital, we first need to find out the issue price or the net proceeds by subtracting the discount and the flotation cost as shown here. Now we substitute these values in the formula for calculating the cost of preference capital such that we get the cost of preference capital as 13.82%. Another variable that should be considered is the tax on dividend distributed. The formula for the calculation of cost of preference shares has to be adjusted for the same. The formula will be as shown here. In the previous example, if dividend tax is 10%, the cost of preference share capital can be calculated as shown here, such that the cost of preference share comes out to be 15.21. For calculating the cost of redeemable preference share capital, the issue price is equated with the series of cash outflows associated with the payment of fixed dividend and the repayment of principal amount. The formula for the same is where P0 is the issue price, PD annual dividend payments, KP is cost of preference share capital, PN is redemption value, N the life of preference share capital. There is also a shortcut method for calculating the cost of redeemable preference share capital, whereby the formula is where PN is redemption value. Let us now solve a practical problem. Suppose a company issues 14% preference shares of face value rupees 100 to be redeemed after 10 years. The company also incurs flotation cost equals to 5%. Substituting these values in the formula, we get the equation as shown here. Solving this equation by trial and error approach, we get the cost of capital equal to 15% approximately. We can also solve the above problem by using the shortcut formula as shown here, such that the cost of capital comes out to be 0.1487179 or 14.87%. In this module, we have learned about the concept of preference shares, the types of preference shares, limitations of preference shares, SEBI Regulations 2013, We have also learned the method of calculating the cost of redeemable and irredeemable preference shares and few numerical problems for the calculation of the cost of preference share capital.
We shall now recapitulate what we have learned so far in this module. Preference shares are those which enjoy the following two preferential rights. Number 1, dividend at a fixed rate or a fixed amount on these shares before any dividend on equity shares is paid. Number 2, return on preference share capital before the return of equity share capital at the time of winding up of the company. Preference shares are a hybrid security between debt and equity because the company is obliged to pay a fixed sum of dividend to preference shareholders before anything can be distributed to the equity shareholders, but this payment is not tax deductible. There are several benefits of a preference share from the point of view of the company, which are: number 1, no legal obligation for dividend payment. Number 2, it improves borrowing capacity of the company. Number 3, there is no dilution of control of management. Number 4, there is no additional charge on assets of the company. The main limitation of preference shares is that they do not carry the voting rights and therefore they cannot participate in company's decision-making process. Preference shares are considered a very costly source of finance, which is apparently seen when they are compared with debt as a source of finance. The interest on debt is a tax deductible expense, whereas the dividend of preference shares is paid out of divisible profits of the company after paying tax. Skipping of dividend payment may not harm the company legally, but it would always create a dent on the image of the company. SEBI came out with regulations in 2013 to govern the issue and listing of non-convertible redeemable preference shares. Cost of preference share capital is that part of cost of capital in which we calculate the amount which is payable to preference shareholders in the form of dividend, which is a fixed rate. Even dividend to preference shareholders is on the desire of the board of directors of company, and preference shareholders cannot pressurize for paying dividend, but it does not mean that calculation of cost of preference share capital is not necessary, because if we do not pay the dividend to preference shareholders, it will affect on capability to receive funds from this source. The measurement of cost of preference share capital poses some conceptual difficulty. In the case of debt, there is a binding or a legal obligation on the firm to pay interest, and the interest constitutes the basis to calculate cost of debt. However, in the case of preference capital, payment of dividend is not legally binding on the firm, and even if the dividends are paid, it is not a charge on earnings. Rather, it is a distribution or appropriation of earnings to preference shareholders. One may therefore be tempted to conclude that the dividends on preference share capital do not constitute cost. This is not true. The cost of preference share capital is a function of dividend expected by investors. Preference share capital is never used with an intention not to pay dividends. Although it is not legally binding upon the firm to pay dividends on preference share capital, yet it is generally paid when the firm makes sufficient profits. The failure to pay dividends, although does not cause bankruptcy, yet it can be a serious matter from the ordinary shareholder's point of view. The non-payment of dividends on preference share capital may result in voting rights and control to the preference shareholders. More than this, the firm's credit standing may be damaged. The accumulation of preference dividend errors may adversely affect prospects of ordinary shareholders for receiving any dividends, because dividends on preference capital represent a prior claim on profits. As a consequence, the firm may find it difficulty in raising funds by issuing preference capital or equity shares. Also, the market value of equity shares can be adversely affected if dividends are not paid to preference shareholders and therefore to the equity shareholders. For these reasons, dividends on preference capital should be paid regularly except when the firm does not make profits or it is in a very tight cash position. Cost of irredeemable preference share capital KP is equal to PD upon PO. For calculating the cost of redeemable preference share capital, the issue price is equated with series of cash outflows associated with the payment of fixed dividend and the repayment of principal amount. For the calculation of cost of capital, we take X dividend price per share. Since debt and preference stock involve more or less fixed payments, estimating the cost of debt and preference is relatively easy to calculate. In the end, we would recapitulate by learning the various types of preference shares. There are major types of preference shares, which are: number 1, cumulative preference shares. When unpaid dividends on preference shares are treated as arrears and are carried forward to subsequent years, then such preference shares are known as cumulative preference shares. Number 2, non-cumulative preference shares. Non-cumulative preference shares are those shares which have right to get fixed rate of dividend out of profits of current year only. Number 3, redeemable preference shares. These preference shares can be redeemed or repaid after the expiry of a fixed period of time after giving the prescribed notice as desired by the company. Number 4, non-redeemable preference shares. These preference shares which cannot be redeemed during the lifetime of the company are known as non-redeemable preference shares. Number 5, participating preference shares. Those preference shares which have a right to participate in any surplus profit of the company after paying the equity shareholders in addition to the fixed rate of their dividend are called as participating preference shares. 6, non-participating preference shares. These preference shares which have no right to participate on the surplus profit or in any surplus on liquidation of the company are called as non-participating preference shares. 7, convertible preference shares. Those preference shares which can be converted into equity shares at the option of the shareholders are known as convertible preference shares. Number 8, non-convertible preference shares. Preference shares which are non-convertible into equity shareholders are called non-convertible preference shares.